This is Mike Taylor, aka BattleshipCobra, and this is the third installment in the Accounting Foundations series. If you've been paying attention, we've been covering financial accounting for consultants. I want to get you to I want to get you guys to understand the basic accounting principles behind SAP and just general basic concepts of accounting. There is no magic to it, and I want to show you that you can do it too, and you can understand a lot more. This is the third video in the series. If you haven't seen videos 1 and 2, go back and check them out. I have a link in the description. Watch them first. They build on each other. In this video, we're going to cover more transactions and more SAP demo stuff to show you how all these concepts we're learning actually work within the system. But before I get started, I wanted to say go to www.battleshipcobra.com, check out my Crystal Reports for SAP Business One course and my SQL for SAP Business One course. If you like these videos, like them. If you want to see more, subscribe. And if you want to get a video every time I make a new one, click the notification bell and join the notification squad. I make new videos weekly, Mondays at 9 a.m. Pacific Standard Time. Don't miss them. So today we're going to jump into the third and final video of this series. We're going to do more transactions, so let's go. Yes, it is hot wearing this outfit, and it is Halloween 2020. I am not just crazy. So the mental framework and methodology, we're going to revisit the previous video. I like to think of what two accounts are you affecting? I want to start to think like, oh, I'm not like intimidated by accounting. What am I affecting? And I'm going to start to get a sense of what accounts I'm going to need to affect. All accounts have a naturally debit or credit balance. So naturally debit, remember assets like cash, cost of goods sold, and expenses. Naturally credit side would be liabilities, debt like credit cards, revenue, or equity. The account types are as follows. And remember, you just have to memorize them. There's no fun and easy way. You just have to know assets are 1,000 level account. They start with ones. A debit increases them, so they're naturally a debit balance. DR stands for debit. And they're increased by a debit and they're decreased by a credit. Number 2, that's 2,000 level account. So if it's like 2000, that's a liability. That's within the liability class. You have a credit balance on those. So crediting them technically is increasing them, and debiting them is decreasing them. Equity, they're not affected that much. They are also a credit balance. And then, so you're crediting them to make them more positive, and you're debiting them to make them more negative, or to decrease them. Revenue are 4,000 level accounts. You credit them to increase them, debit them to decrease them. Cost of goods sold is level 5, and the level 5 accounts, you debit them to increase them, credit them to decrease them. Level 6 are expenses. You debit them to increase them and credit them to decrease them. So just memorize this chart or have it close to you. This is kind of, again, the entire point of Accounting 101 or 100, whatever. It's the entire point of it basically boiled down into this concept. So we're going to jump into order to cash example within SAP. So what is order to cash? Order to cash is like your quote to an order, order to the delivery, delivery to the invoice. So I'm just going to cover those things, and we're going to walk through specifically what happens in SAP. So here is what happens. Quotes and orders. No entry. There's no entry. All you're doing is a quote is just giving somebody a specific quote on an item or set of items. An order is the order, but there's no financial impact to that order. No entry. Once you do the delivery, you are going to decrease your stock by crediting it because inventory is an asset. You own it. It's part of the business. It's not a revenue. It's not an expense. So you own stock. Stock, when you're increasing it, is a debit. And when you're decreasing it, it's a credit. So we're saying reduce our stock because we're selling it. So we're going to credit stock. And cost of goods sold, that's our direct expense for our widget. So at the cost that it cost us, we are going to move the balance from inventory into expenses. So that's the delivery. The delivery sends out inventory into the world. You copy the delivery to an invoice, which increases your accounts receivable. That's what the customer owes you. They're not giving you cash necessarily directly. They could be, but a lot of times it's on terms. So it goes to accounts receivable. Even if it was going to be paid directly, you typically go to accounts receivable and then immediately go to cash after. We'll talk about that in the next slide. So invoice increases accounts receivable. Debit, because accounts receivable is something you own. You own the fact that that customer owes you money. So that is an asset to you. Even though you don't have the money in your hands, they owe you that money. So it's a 1,000 level account. Debiting it increases it. Then you're going to add to sales. So sales is going to go up, and sales is a credit balance account. So you're increasing sales and you're increasing what the customer owes you. So that's a 1,000 and a 4,000 level account. So let's look at those in a little bit more detail. Delivery, COGS, debit, $500, inventory, and that's a 5,000 level account. Inventory is a 1,000 level account, and we're going to decrease it with a credit. The invoice increases your accounts receivable by 1,000, and it increases your sales revenue, which is a 4,000 level account, by 1,000 too. So let's take a look at this in the system. So in the system, we're going to start with sales order, and I just have this handy dandy example here. So this is just an example of journal remarks. There's nothing. You're not doing anything there. There's no entry. Right click, you can see relationship map, and you can see the sales order, delivery, invoice, and incoming payment. I'll do the incoming payment in the next set of transactions. Sales order does nothing. Delivery, we can double click on the delivery, pops open, and you can see accounting, journal remarks, inventory. Again, you're issuing inventory out. So inventory down. What you own, a $500 piece of inventory is now out. That was on your balance sheet and now it is gone. And then cost of goods sold is increased by $500. Okay. So we have $1,000 unit price, but the cost of this keyboard, it's a very expensive keyboard. The cost of this keyboard on the books is $500. So when you have it in your balance of your inventory, you're storing it at 500 as part of the body of your business, and then you're decreasing it with a credit because you're issuing it out, you're selling it. So what you are selling with the value of that cost of that inventory is the 500, but what you're charging is the 1,000. But the packing slip delivery does not do that entry. So you can go next target document here, or you can go back to this nice relationship map and double click the invoice. Once this opens, you're going to see accounting, journal entry, and you're going to see here, it's a subledger. And if you don't know what subledger, go back to video 1, C001,000. So that's the subledger specifically for BattleshipCobra within the control account of accounts receivable. CAD. Then it's going to increase that because now BattleshipCobra owes us $1,000 more, and we had $1,000 worth of revenue. So part of the GAAP, generally accepted accounting principles, those principles is you have to match your cost of your sale to the same time period as the sales revenue. In order to properly account for things, you should have that COGS transaction and your revenue transaction in the same period. So that's what you will have here. And that will keep the scorecard even, because if you had revenue in one period and then costs in another, you might be like, oh my gosh, I made so much money, but you're not recording the cost in the same thing. So you don't really need to know that. That's a more advanced concept of GAAP. But that's the matching principle, I think. Ooh, look at me go. And you don't need to know that, but that's something that accountants will consider. And that's why they reclass things, or they put accrued stuff and they move it around, or if it's something that you haven't delivered on that project yet, but you have costs for it, they'll accrue it and put it in the next period and blah, blah, blah. There's all this stuff that they do. You don't need to really know that, but for now, this is what you need to know. You need to know that the sales order doesn't do anything. The delivery reduces your stock at your cost, and your invoice increases accounts receivable and asset and revenue a revenue. Okay, so you managed to sell something to a customer. They now owe you money on accounts receivable. You can say, wow, this customer owes me $1,000. That's great. Are they ever going to pay me? You send them the invoice. You're like, please pay me, please. And then they finally send you a check. You're like, oh my gosh, I'm a millionaire. I'm $1,000 heir. Okay, so an invoice, again, increases your accounts receivable and increases your sales. Now, you're going to do incoming payment by check. And I put the CHEQUE because this is a Canadian video. Deposit to the bank, and that will all reconcile everything together. So you have two transactions. The incoming payment, you're now decreasing your accounts receivable by $1,000 because you just got a $1,000 check. And in the chart of accounts, you will have checks to deposit, which is also an asset. You can accumulate checks to deposit. And what happens is, say you have 5 checks in a day. A lot of businesses have a lot of checks. You will put all of your accounts receivable to all the checks through all the checks of the day. Then at the end of the day, you're going to take all the balance of all those deposits and do a deposit sheet and drop those checks into the bank. That is the reason for the deposit slip, because the bank is not necessarily going to break each check out. They're going to say you did a deposit for the total of X dollars. So if you just put everything into the bank transaction by transaction, it might be really hard to match what the bank actually sees. So your deposit might be $10,000, maybe there's $10,000 checks. You want to see $10,000 deposited. So each payment, because when you take and record the payment, the check is still on your desk. So in the case of a check, obviously with credit cards and all that stuff, you're charging it right to the account. But even credit cards you have to settle later. A check, you take the check, you say, wow, $1,000, blah, 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 boop, put that on your desk. Now you're building that up into checks to deposit. Then you do the deposit to the bank. You take all those checks and you put them in the bank. So let's take a look at that in the system. So back to our sales order here, right click, relationship map. So the nice thing about the relationship map is you're going to see the incoming payment, 157. You can see BattleshipCobra, and we have a specific thing, and we have a document here, and the document here is 160777. I only have the one document. You could pay multiple documents. In this case, I was trying to keep it really simple. Transaction 3903. So the journal entry here is we're going to decrease the accounts receivable to BattleshipCobra. He doesn't owe us the $1,000 anymore. And we're going to put the $1,000 in the checks to deposit. So now we go, okay, time to bring all that money to the bank. Deposits, deposit. And we'll go to the last one. And we'll say, okay, we're putting it in the bank, our Canadian bank account. And these are the checks that are included. I don't know why this isn't checked, but this is part of this one that we did. So the check is 1, 2, 3, 4, 5, 6. If we looked at the incoming payment, payment means we recorded that it was customer's check 1, 2, 3, 4, 5, 6. Yes. We're looking at the deposit 1, 2, 3, 4, 5, 6. It's a CIBC to BattleshipCobra. And the total is for $1,000. And we've added this deposit indicating on this day we had a slip that we're going to deposit to the bank. We can look at the journal entry. Journal entry is exactly how I showed it. It's going to decrease the checks to deposit because we no longer have it on our desk. And we're going to increase our bank account because it's now deposited into our bank account. So that summarizes a normal order to cash payment process. And that should get you kind of thinking in the accounting way. It shouldn't be too complicated so you can see why certain things are a certain way. So the next thing we're going to do is the payables. So the payables is very similar. Let's run through this process here. So purchase order, again, no entry. It is a contract to buy something at some amount of money. You issue a PO to a vendor. The vendor sends you something or does something. You do a GRO, a goods receipt PO. This is for an item type where you actually have inventory. If there's no inventory rendered or no goods moved, you might just go to the AP invoice. So this is not exactly what you would do. But you have a goods receipt PO. The inventory is debited. The debiting of it increases it. And then you have a sneaky little account called goods received, not yet invoiced, typically called gurney. So the receipt of the goods you want to increase your inventory right now because you've got that inventory on hand, but you don't have an inventory or an invoice, an AP invoice to match yet. So you just say, hey, we also have a 2,000 level liability saying we are going to have to pay for that inventory at some point. We just don't have the specifics for that. So it's what's called accrued or stored in a liability, and liabilities are increased by credits. So you have that entry. The AP invoice comes along, you take the packing slip from the vendor and you take the AP invoice, and then you take the PO too, three-way match. So you match the PO, the goods receipt PO, the packing list from the vendor, and then you'd have an AP invoice that could be emailed to you from the vendor or might be included with the shipment. You match the PO, goods receipt, and the AP invoice, three-way match, you compare them all. You do your entry for the AP invoice. The AP invoice then debits the liability of goods received, not yet invoiced, because it's something that you will owe. It's decreasing it with a debit. And then it's increasing your accounts payable. So now you owe the vendor that money specifically. So let's take a look at those journal entries. So goods receipt PO would increase your inventory because you got it. It's now in your little hands. And then you have goods receipt not yet invoiced. It's a liability because it's a 2,000 level account. So you're increasing a liability saying, I will owe $1,000 at some point worth of inventory. And then I'm increasing my asset of inventory because I now have that inventory and I could potentially sell it right away. The AP invoice comes along and it reduces the liability. It takes away that $1,000 of like, hey, we're going to owe somebody money sometime. Now we really do owe that money. So that $1,000 is now $1,000 less of gurney, and now it's a real payable because it's a real document with a real due date, and then it makes your accounts payable increase. So let's take a look at that. Okay, so we're gonna go modules, purchasing, purchase order. Last one, because I just did that as an example. So we're gonna buy this Logitech keyboard, $500 for one. So this PO is a promise to buy this, and we've said, hey, give us this. This is a legal binding agreement that we're entering into. Right click, relationship map. The relationship map will show you all the different transactions here. I can actually make this a little wider. PO to goods receipt PO, goods receipt PO to AP invoice, and then outgoing payment I'll cover in another slide. Purchase order as no transaction, goods receipt PO. You copy the PO to the goods receipt PO. You double check the quantities and you say, okay, we did get one of these keyboards, accounting. Let's look at the journal entry. Gurney is increased because we need some way to offset this inventory and we don't know exactly how much we're going to pay for it. There could be differences in the price of that item and we don't know yet. We have to match it. Maybe stuff's damaged. We need to have division of labor to check the specific totals are correct. So the person in the warehouse is checking physically how many items were received, and they just have to think about quantities. The quantities should match the dollar amounts that the PO was correctly entered. The PO should enter at what the cost is going to be in the future so you can accurately see what your payables will be in the future. The cost of goods sold, the goods receipt not yet invoiced, gurney, is increased and it's a liability. It's a 2,000 level account. We will owe money in the future, and the inventory is an asset which is increased. It's a 1,000 level account. Well, in this case, it's a million level, but it's a 1 in the front, so it's an asset. So you're increasing it with a debit. You're increasing your liability to gurney. Oh, close that. We go to the AP invoice. Double click this. So we're going to see this accounting journal entry. Boom. We hit the accounts payable 2,000 level, accounts payable CAD. We're increasing it because it's a liability. We're increasing our accounts payable for the subledger for vendor number 1, and we're decreasing goods received not yet invoiced, which is kind of a miscellaneous account with the inventory. So we're saying decrease that by 500. We don't know that 500 miscellaneously anymore. Now we have an actual accounts payable that we need to pay that does have a date that we need to pay it on. Do you see the kind of trend here? you can kind of logic these through, and these are kind of the basic foundations of accounting here. So the next step in this process, surprise, surprise, is we have to actually pay. So you have AP invoice. Remember, it decreased Gurney and made a real accounts payable entry. We're going to do an outgoing payment by check, and then we're going to do a check run. The only financial transaction in there is you're going to do the accounts payable of $1,000 to decrease it, because remember, a liability is decreased by a debit. No more. We don't owe that $1,000 anymore. The bank account is an asset, so we're decreasing that by $1,000. So we're saying we're going to be $1,000 poorer, but we will owe $1,000 less. So those two transactions cancel each other out. They're reconciled all together. Let's take a look at this in the system. So we have the PO here with the relationship map. Double click the outgoing payment. We paid by check, and we can see we paid this particular document for $500. The transaction here, this decreases our bank asset, and it also decreases our vendor accounts payable asset too by $500. So you can see the control account, $2,000. Accounts payable, so you owe $1,000 less, but you're also $1,000 less rich. So now that you're starting to understand transactions and how money flows around the system, you need to understand some basic financial foundations of how SAP defines those transactions and where those accounts are defined. So you've probably heard of GL account determination. Well, why do we use GL account determination? Well, it sets up the basic mapping for customers and their chart of accounts to the transactions. So you're going to take the customer's chart of accounts, import it, or make it manually, and then you're going to map where their transactions and their classes of items will affect their revenue accounts, assets, liabilities, and all the basic transactions of all the things they're normally going to do. Typically, it's basically those two things, accounts receivable and accounts payable, because businesses take money in and businesses send money out. Then you're going to have advanced GL account determination, which is the exact same thing. It's just more complex mapping. Maybe you have geographical revenue. Maybe you have more complicated scenarios or other little things that you need to tune. It just makes things a bit more complicated, but it takes the basic GL account determination and makes it more advanced. I have a great guide, which I'll include in the resources below, which will give you a good basis of understanding what accounts are doing what and what classes of accounts should be affected for each of the different types of GL account determinations. So let's take a look at the system and we'll take a look at my guide. So as you know, GL account determinations, modules, administration, setup, financials, GL account determination. You can see all these different classifications for all these different things, sales, purchasing, general, inventory. And then you can look at this GL account determination guide. I didn't write this, but this is really, really good. I use this all the time. So this defines all the classes of all the different accounts in all the different areas. And so it'll say purchasing, domestic and foreign accounts payable, AP, credit invoice on the journal entry, or AP invoice, a credit account in the journal entry should be a liability account in the current section. So it's going to tell you specifically what is happening. Debit or credit to the incoming payment can be expense, revenue account, in the cost of goods sold, financial, other drawer. So you're going to have all these different things. Let's go down to inventory. So we're going to have inventory. Inventory account used in goods received PO, delivery, inventory transfer, and production orders. Has to be an asset in the current section of the asset drawer, etc. So this is really good. It's a guide. It'll give you a whole bunch of information, and it's really worth checking out. Another big deal is financial reports. Customers are going to talk about financial reports because they want to see how their business is performing. So we're going to have, again, the balance sheet, the body of your business. It's run at a single date. It gives you the full history of all of your assets, liabilities, and equity. It's a picture of the health and the business and the body of your business. How much do you own? How much do you owe? And what are your profit and losses? What do you owe to investors, owners, etc.? P&L. You run it for a period of time. It gives you a sense of what the activities are of your business and what your performance is given a period of time. So you're going to run that for a financial year. And at the end of the year, you're going to reset that. And I'll talk about that in a minute. Trial balance, again, gives you an idea of all your debits and credits for all of your accounts and gives you a moment in time or a period of time where you're going to see all the debits and all the credits in those particular date ranges in order to do cross-checking, comparison, and to send to auditors and other things that accountants do with that stuff. General ledger is all of your transactions, so you can see each transaction row by row by row, usually grouped by account, and it's like the history, like a log file of your whole business, and usually it's organized by accounts, and it just says debit, credit, debit, credit, debit, credit, 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 debit, debit, all that stuff. It's just like a log of what you're doing. The debits always equals the credits. Keep that in mind in all sides. If you don't have those balancing up, something is not working properly, that's the foundation of this double entry system that helps us track everything through and count those beans. Year-end closing. So this is another one you're going to get questions about. So year-end closing, what do people want to do? So this is where you're kind of like preparing your scorecard for your business, and you're make sure everything's finished for the 2020 fiscal financial year, whatever. You're getting all your data in. You're massaging all your final documents and getting all your payments out, and you're reconciling your commissions and your blah, blah, blah. So you net you do all of your final transactions, and you say, okay, everybody stop. Now we need to prepare the scorecard or the P&L, basically, and all the other documents you need to close. Net and close all your P&L accounts. So you're going to say, if you had $1,000 of revenue and $500 worth of COGS, the revenue is going to be a credit balance, and the COGS is going to be a naturally debit balance, and you write those together into current earnings in the 3,000, and then that becomes what you write over to your equity. So that gets written over to equity. So that would be a $500 profit for the year, and that would be what you do. So by the end of the year, when you start the new year, you're going to have zero in all your P&L accounts. All your activities are wiped clean, and you've net those all up into your net loss or net profit for your business. You're going to run a balance sheet that shows the status of your body, what you own, what you owe, inventory levels, all that stuff. What do you owed by customers? What do you owe to vendors? What's a picture of the health of your body at that time? You're going to do the profit and loss right before you do the netting, obviously, to show your full balance of what your revenue was, your cost of goods sold, and your expenses. So you can say, what did we do? How much money did we make? What did it cost us to make that directly? And what did it cost us indirectly? And what did it cost us to operate, which is expenses? So they're going to do the trial balance, match your balance sheet and your P&L, so that those all match. The AR aging will be run to expand the balance sheet account for accounts receivable and show how much money is owed by each individual customer and when it will be due. Same with the AP aging. It'll break out what you owe to vendors, when you owe it to them, to match that balance sheet account, to expand it, to give you detail. The inventory audit report will be run to break out all the inventory audit. The inventory audit report will be done to break out all the inventory balances into the SKUs with their associated cost on the books. And that's basically the year-end close. There's some other things and some industry-specific things, more accruals and some more accounting things, but this is basically a common year-end close process. Net everything, run your reports, make everything match, do your adjustments. They'll usually take this package of information, give it to the accountants. The accountants will give you some feedback, you run some adjustments, and then you run the period-end utility again, and boom, you lock all the posting periods, and that's it. It's not really that complicated. So my final example here, and just some words again to live by, memorize that chart and stop and think about what accounts you need to affect. Think about the invoice example, sales revenue, accounts receivable, COGS, inventory, the debits and the credits of each of those transactions. Look back at that list and memorize it. That's all you really need to know. Thank you guys so much for watching this series. I hope you got a lot out of it. If you have any questions, post them below. I really appreciate it. Visit www.battleshipcobra.com. Like if you like this video. Subscribe if you want to see more. Click that notification bell. It'll send you an email every time I make a video so you don't miss it, especially if you don't come back to YouTube that frequently. I make weekly videos, Mondays at 9 a.m. Pacific Standard Time. I wish you all a safe and happy Halloween, if that's your type of thing. Battleship Cobra out.